IRS Section 179 deduction, what it is and why you should care if you're a small business owner. The thing with business tax deduction is that they not only reduce your taxable income in the short term, they also help you plan your operational activities and business model in a way that it is profitable, sustainable, and compliant in the long run. The more you can take advantage of the deductions, the lower your taxable income will be and the less you will owe overall in taxes. Check out how Section 179 deductions can be a big tax break for small businesses and entrepreneurs whenever they make a big purchase. Welcome back, folks, to another edition of Sweetie Kiwi. How you doing today? I hope you are doing fantastic. I'm doing marvelous if you were to ask me. Today we are having a conversation around IRS Section 179 deduction, what it is and why you should care if you're a small business owner. Now, before I get into the nitty-gritty, this video is not about giving you particular fiscal advice. We're not tax experts. We've done research. The whole team has done research, and we are presenting to you the results of our research. Now, if you have a particular question about your business or a personal situation, we would advise that you talk to a CPA, a certified public accountant, an enrolled agent, an EA, or any kind of tax attorney, anybody who has expertise when it comes to the intricacies of the United States tax law. Now, let's talk about Section 179 and let's define it. The Section 179 deduction allows businesses to deduct the entire amount of an asset in the year it was purchased, rather than deducting a smaller amount over a number of years with the depreciation method. Let me just break it down for you. Now, first, let's talk about asset. What is an asset? Asset is, here we're talking about a long-term asset. A long-term asset is something that you would use in your operations for over 12 months. So minimum time frame is 12 months. If you have anything below 12 months, you don't call it a long-term asset, you call it a short-term asset. So a long-term asset can be property, plant, equipment, machinery, a car, building, anything you use in your company over a period of 12 months. Now, when it comes to long-term asset, they are also called capital asset or fixed assets. They are usually depreciated. In other words, if you spend, say, $1 million today, and you acquired machinery, let's say you acquired a Caterpillar equipment. I'm not advertising for them, but Caterpillar machinery, right? For $1 million. Now you are going to have to depreciate that over 20 years, for example. So what happens is that the $1 million you spend today to buy that equipment, that machinery, you're not going to expense the acquisition. You're not going to put expense of acquisition of machinery for 1 million. No, you are going to depreciate that over 20 years. In other words, you're going to take 1 million divided by 20. That's 50 grand. So 50,000 will be your depreciation expense. So every year for the next 20 years, you are going to put 50,000 as expense. And so your income for that year will be reduced by 50,000 every single year. What happens here is that with Section 179 deduction, you are able to expense the whole $1 million in year one. So instead of depreciating this over 20 years, you are able to do it in 1 year. So your income for the year where you acquired the machinery will go down by $1 million. This is fantastic because if your income goes down, so does your taxable income and so does your taxes owed. Remember though, when it comes to accounting standards, because Section 179 applies specifically to the IRS, right? So which means that your taxable income will be different from your financial income, from your accounting income. This is where we have a little dichotomy between what the IRS is fostering and what the US GAAP. So this is the US generally accepted accounting principles are fostering. So you have some kind of mismatch there, and there is a reconciliation to be done between your accounting income and your taxable income at the end of the year. But this is the topic for another subject, another video here. So Section 179, just to quickly say this, you are able to deduct the full amount you spend on a fixed asset in the year you purchased it. Now let's talk about depreciation versus Section 179 deduction. Now, how does the Section 179 deduction benefit a small business owner? Now, let's go back to my earlier example. Let's say you buy $1 million of equipment for your business. The equipment has a useful life of 20 years, and you depreciate it using the straight line method. Now, when it comes to depreciation, again, I'm going to try to keep things very simple here. You have something called straight line, and you have something called accelerated depreciation. Now, in this case, straight line means you take the same depreciation amount every year. So we'll ignore scrap values in this calculation and just say that by depreciating the equipment, you'll have a depreciation expense of what? $50,000 each year for 20 years, right? 1 million divided by 20, that's 50,000. This can be a strain for a business because even though you paid, say, $1 million all in 1 year, you cannot take a deduction for that full expense in that year. So only taking 50,000 deduction each year can be challenging to your cash flow in the year you make the purchase. So Section 179 does a great job because it offers you an alternative to this scenario. So now, rather than deducting the expense over 20 years, you can deduct the full $1 million in the year you made the purchase. That's what I said before. But the great thing here is that you are able, and this is where depreciation, this is where Section 179 deduction actually is great. It allows you as a small business owner to match your deduction to your cash flow. So you are deducting $1 million because actually $1 million came out of your cash flows for that particular year. I'll be right back. Right after this, don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We're actually having a conversation today around IRS Section 179 deduction, what it is, and why you should care if you're a small business owner. Now, if you love the clarity and quality of the content so far, please consider subscribing to our channel and turn on the notification bell so you are informed whenever we drop a new show. And we drop these shows every single day, rain or shine. Comment below, share, and like this content. What are the eligibility requirements for a Section 179 deduction? Remember, though, that not every asset that you purchase will qualify for a Section 179 deduction. Let's talk about the qualified asset. Now, if you want the exhaustive list, you have to go on the IRS website, www.irs.gov, and you have to search for Section 179, and they have a long list of assets there. Now, qualified assets include tangible personal property. I mean machinery, equipment, furniture, and computers. It doesn't include building and land, but it can include things that are attached to a building, like grocery store counters, refrigerators, office equipments, and signs. Now, let's just quickly talk about why does land and buildings are not included. Why are buildings and land not included in Section 179 deduction? Very simple. Land does not depreciate. Buildings do not depreciate. Generally, land will always appreciate. So the IRS in the Internal Revenue Code has made the decision that small business owners should not deduct land, the cost of land and buildings as a Section 179. Now, other property that is an integral part of manufacturing, production, or extraction can also be deducted. Livestock plus livestock and horticulture structures are also deductible. Improvements made to non-residential real property like roofs, fire protection, and alarm systems and security systems are also deductible. Now, if the asset that you purchase is allowable to qualify for the deduction, it will also have to meet the following criteria. It must have been acquired for business use. Very important, folks. If you have an asset that is used both personally and in business, it must be used at least 50% of the time for the business. 1. It must have been purchased. Anything that was given to you or inherited cannot qualify. So you need to spend some money to be able to take out the deduction. it cannot have been purchased from a related party. So you also cannot have purchased the items from a related party. I'm talking about a spouse, a sibling, a parent, or grandparents. If you buy a printer, say you buy a printer from your brother, that does not qualify. You cannot lease it to others. Generally here, the Internal Revenue Code will not qualify property if you purchased it and leased it to someone else. There are exceptions to this though, like if you lease it for less than 50% of its useful time, then it's okay. And it must be placed in service. You must actually start using the property to have it qualify for a Section 179 deduction. So for instance, if you buy property in say May, but don't actually start using it until February or March of the following year, you cannot take the deduction until the tax year that you actually begin using the asset. So folks, you want 5 things that you have to think about for the asset to be allowed, for the IRS to allow you to deduct an asset under Section 179. It must have been acquired for business use. It must have been purchased. It cannot have been purchased from a related party. You cannot lease it to others, and it must be placed in service. Let's talk now about limits for Section 179 deduction. Now, in general, you can deduct the full cost of the asset if it meets the criteria of an IRS Section 179 deduction. Now, there are a lot of things, as we all know, most things in the tax code, there are restrictions, right? Things are not that simple. Here are the restrictions. You have something called property value limitation, and then you have a business income limitation. So if you purchased and began using more than 2,590,000 of Section 179 property in a year, you will reduce the 1,040,000 limit by the amount you exceed 2.59 million. What I'm trying to say here is that Section 179 has maximum amount you can take. So for 2020, for example, Section 129 deduction that you can take as of the 2020 tax year is 1,040,000, but that can be decreased in some cases. So that's for the property value limitation. Next, you have the business income limitation. Now, your total deduction cannot be more than your taxable income from active trade or business for the year. If you have, say, 200,000 of Section 179 property to deduct, but your total income, your total net income is only 150 grand, you can only take a deduction of 150,000. That remaining 50,000 isn't lost though. You can carry the remaining deduction forward to the next year. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We are still having a conversation here around IRS Section 179, what it is, and why you should care if you're a small business owner. Now, let's talk about steps to taking a Section 179 deduction. How do you actually take a Section 179 deduction? Now, to elect the Section 179 deduction, you'll need to file IRS Form 4562. Let me repeat that, 4562, with your federal income tax return. On this form, you will provide a description of the asset, cost, and the amount of the deduction you're claiming. Now we put on the screen here how Form 4562 looks like, and also put on the screen the link on the IRS website. So it's www.irs.gov/pub/IRS-F4562.pdf. We'll put a link on the video. You can see it, and here's how the form looks like. So you have depreciation and amortization. You have Part 1, Part 2, Part 3, Part 4. So Part 1 is you have to, this is election to expense certain property under Section 179. So you need to put the maximum amount. You have to put the total cost, the dollar limitation that I spoke about, and the reduction and limitation, right? And then if in case you cannot take all the deduction, you have to put the carryover on line 13, you have to put the carryover of what they call disallowed deduction for 2020. And then you have the part 2, the special depreciation allowance and other depreciation. And the third, you have the maker's depreciation, which is the modified accelerated cost recovery system. Let me repeat that. So maker's stands for modified accelerated cost recovery system depreciation. That's another type of depreciation. We'll talk about it on another video. But here, this is if you have some kind of a maker's depreciation, you put it here. Whether the property is a 3-year property, 6-year, 5 years, 7 years, 10 years, 15 years, 20 years, 25 years, whatever length of time the property has, then you put it here. And on this form, if you look into the on section B, part 3, section B, one thing I want to draw your attention to is you can see that in column F. So you have a column F. You have something called SL. So SL stands for straight line. So the IRS would allow you to depreciate the property using the straight line method. All right. So in part 5, you put the summary, you sort of wrap up everything, and the part 5 continues here where you have to put the property actually, what kind of property it is. So automobiles, certain other vehicles, certain aircraft, property used for entertainment, recreation, and amusement. So this is, I was just trying to tell you what the form looks like, and this is how you actually elect to use IRS section 179 deduction. But again, folks, if you have no knack for accounting or taxation, I would strongly advise you to enlist the help of a specialist. And this can be a CPA, a certified public accountant, an enrolled agent, EA, a tax attorney, or any kind of a fiscal expert who can help you navigate the subtleties of the Internal Revenue Code. Never do things on your own, and don't take this show as equivalent to advice. No, we are giving you, we've done research here. Some of us are accounting and finance professionals, and we have done research in addition to our own expertise to give you something potent, something interesting when it comes to understanding the whole general topic of section 179. Now, for your particular company, your particular small business, we will strongly advise you to reach out to an expert, because everybody has a different situation, a different setup. All right. So today's conversation is pretty much coming to an end now. I'm going to wrap up here and give you the recap here. We spoke about section 179 deduction. We talked about depreciation versus section 179 deduction, the pros and cons actually, eligibility requirements for a section 179 deduction, limits for a section 179 deduction, and the steps to taking a section 179 deduction. Thank you so much for your attention. I will speak to you another time. Until then, remember, stay marvelous.